At Capella University, you can learn at your own pace with our FlexPath learning format. Take 1 or 2 courses at a time and complete as many as you can in a 12-week billing session. With FlexPath, you can even finish the bachelor's degree you started in 22 months for $20,000. A different future is closer than you think with Capella University. Learn more at capella.edu. Fastest 25% of students. Cost varies by pace, transfer credits, and other factors. Fees apply.
Reality radio for a really great future. We're talking real money.
Don't say it. Do not say the D word. Don't say it. We are not going to talk about that little 30 stock thing. Throughout this program, there will be no mention of the thing they just mentioned in the news at the top of the hour. This is a D word free zone. We can say down, but if it's a word without the N at the end of it, we don't use it. It ain't the market. But we are going to talk about the market here on Talking Real Money. Why? Well, it is the proverbial elephant in so many different ways in the room. It is. It's an elephant of sorts. And I know that you're thinking about it. We're pretty sure, though, if you're regular listeners, you're not obsessing on it. You're just thinking about the fact that, well, the market, the U.S. market, by pretty much any measure, is in what is called a correction. Would that be accurate, Tommy?
That would be accurate. I've been spending a lot of time in my little new office here trying to find
new office
missing $5 trillion that
I thought it was six that
somewhere.
I thought it was six that have
okay. I feel better then, I guess. Yeah, it wasn't a fun week. There's no doubt about that.
If you're concerned about your money, or you aren't, and you just want to talk about things that impact your bottom line, we would love to have you call us on our little phone number that's still that anachronistic toll-free thing, 855-935-TALK, 855-935-8255. We're here every Saturday, noon to 2 Pacific on Northwest News Radio, and then on a podcast the rest of the time. So important stuff going on. So here it is in a nutshell. In a nutshell, we've had tariffs imposed by the administration, and then they backed off a little bit. Market went down with those tariffs, and then it recovered a little bit. Then last week, we got Judgment Day. Is that what they called it? Judgment Day?
I think that is what I think you're right, yes.
I don't know. I'm not sure, but
Liberation
feels,
Day. I think you're having fun. Yeah, okay.
You think I am? Oh, okay.
Yeah,
so
you just get
it's not apocalyptic? Okay, good. They came up with this wacky system to charge tariffs of even islands that are only inhabited by penguins.
Which should have large tariffs in my mind, by the way. Yeah.
So what it did, though, is the markets, the investment markets, the stock markets in particular around the world, do not like uncertainty. They want to know, is there a tariff? Isn't there a tariff? How much is the tariff? What's the tariff going to do? They want to know these things so that, well, because it's made up of businesses, so they can plan.
Yeah, and businesses have a tough time when they don't know what's going to happen the next day. But let's just very basically give you a few of the facts, right? Because there's so much
you don't use the D word. Do not
noise.
Use the D word.
Yes. So the Standard & Poor's 500, I'm off the hook, I guess, now, good. Right? I feel so much better. The Standard & Poor's 500, the 500 largest companies in America, is now down 14% year to date. Okay.
All right. And that's very interesting because that compares with the index that I like better, which is the Too Much Information Index, or the S&P TMI, Total Market Index, which is the whole U.S. market, which is, by the way, for the year to date, the whole thing down 14.3%.
Yeah. Okay. But if you're globally invested, you got stocks in other countries, lots of stocks in other, big ones, small ones, good ones, bad ones. That portfolio, got to get my grandsons in here. That one is down 10%. But here's the thing. When you hear these numbers about all that kind of stuff, it's not very relatable to you listening because very few of you are 100% in stocks.
Right.
Very, very few people. Let's just say, for example, that you're in that so moderate 60% stock, 40% bond part. Oh, bonds.
You mean the balanced funds?
The bonds, that's right, that nobody wants to talk about because they haven't made very much money in the last 10 years. Well, guess what? That balanced portfolio is only down 5.5% year to date. Doesn't sound so threatening when you look at it that way, now does it? And here's the other part that's fascinating. I mentioned the S&P 500 down 14. International value stocks are still up 3. International small cap value stocks still up 1.5%. So between the S&P 500 and those international value stocks, that's a 17% difference in performance. That's why you're diversified. That's why you hold a global portfolio and you don't concentrate in one type of stock.
Yeah, and that's the thing that you don't hear when you listen to the typical money media. It was funny. Yesterday, my wife wanted to watch CNBC so badly. So badly. And then she said, should we watch the nightly news? And I said, no. Because what are they going to do?
You already
know. They are going to blow all of this out of all semblance of proportion. There is no reason to torture yourself by following the news that you know is going to say the same thing over and over and over again. And by the way, I looked at my own portfolio.
Oh, you're so brave. I didn't look at mine.
My taxable portfolio.
I didn't go there.
And because it's well diversified and it's about 70-30 global, I was down. Guess what? I was down.
How much?
Right about 5%.
Yeah,
for the year to date. And
you got a few of those bonds. Yeah.
What's really interesting is that my 2-year return is 2 years with one bad year in there. My 2-year return is about 12%, 13%.
You're still up. I want to talk in a couple minutes about some of the lessons we've learned, by the way, from all this. And let's not forget, it wasn't that long ago that there was quite a bit of volatility in the market. I think it was just like 2.5 years ago, 3 years ago. So
well, that was COVID. That was different.
No, 2022 was interest rates. 2020 was COVID.
Interest rates. Yeah,
Now you got tariffs. So I want to talk about that.
They're all blurring together, but it's funny. They're all similar though in that they sprang from things that were unexpected.
A surprise. Thank you. Because this has never happened. No, it has happened. It was a different surprise last time. That's all. As you said, markets don't like the unexpected, and they're reacting to that. Oh, by the way, the aforementioned bonds, here's a fund that I use as a proxy for intermediate term U.S. government debt, DFI. It is now up 4.5% year to date. So we're not always saying that they counterbalance, but oftentimes there's good reasons to have the fixed income in there.
Okay. Well, then I think we've got this figured out. But we're going to talk about it more because it's really important that you understand it so that you don't do the thing that causes the most harm to your portfolio, and that is get emotional, panic. 855-935-TALK is our phone number.
Tom and Don are talking real money.
This episode is brought to you by LifeLock. It's tax season, and we're all a bit tired of numbers. But here's one you need to hear. $16.5 billion. That's how much the IRS flagged for possible identity fraud last year. Now here's a good number. 100 million. That's how many data points LifeLock monitors every second. If your identity is stolen, they'll fix it. Guaranteed. Save up to 40% your first year at LifeLock.com/podcast. Terms apply.
Your guides to a really great financial future. Tom and Don are talking real money.
It's different this time, right? Yeah, no, it's not.
Isn't it always? Come on, yeah, sure.
Different. Well, it is in a way. It's always some different thing that ignites, that is the spark that begins whatever kind of downturn we end up in at any given time when we have one. And we've had them over and over and over again. As a matter of fact, since I first started I just realized that my first ever financial talk show was just after, this is how old I am, the crash of 87.
And what a crash that was.
I started in 88. It was just after that. And then
that's the same year that I started programming the radio station here in Seattle and put your show on.
We've had so many.
Yeah.
We've had so many of these along the way, and they come when you... And don't tell me you knew this was coming. You knew the tariffs were coming.
Saw this. Yeah, nobody saw this
coming. You knew the tariffs were coming, but the problem is you don't know how big it's going to be. So, what should you do? And this is the question you should be asking yourself. What should I be doing now that the market has fallen more than 10%?
Yeah, I think some great takeaways here, by the way. Number one thing you should be doing is considering how much risk you're taking in your portfolio and is it appropriate? You
mean not based on what it's doing now? Am I taking too much risk for this situation?
This gets back to you have a plan that tells you here's... this should have been done.
Wait, I was going to say, this sounds like something I should have done a long time ago.
Yeah, you should have. These are all things you should have done, but you still could do. You could still do them. Now, I'm not saying we find out you're taking too much risk and run out and sell everything today.
Well, but see, that's what I think a lot of people think when they hear that is that, okay, well, it's way down, so I should, my portfolio is 90% stocks. I think I should take it down to 50 or 10.
This is why people, the Dalbar just released their number for 2023, I think it was, but they say investors made half of what the they made 5%, less than the S&P 500 in 2023. I had a 2023 number. But, okay, that's one. Number two is you should be examining your portfolio to see how much concentration you have. This is something that we have talked about a lot the last couple of years. It's something I've talked to many of you individually about because so many portfolios are centered around not just the S&P 500, but centered around technology. And guess what? What's had the biggest hit here really since the first of the year? Technology. The people that went straight up.
The ones that everybody said, well, why in the world would Apple go down?
Yeah, okay, let's get to that because that's another lesson. This is another thing we try to talk a lot about, so it's a bit of repeating, but owning individual stocks, I'd like to say is risky because of the default risk, right? They can go out of business. But what you're really learning now is there's a lot of volatility risk. I mean, look at some of the individual companies that have just gotten the tar whooped out of them, right?
Apple just in the last week, and bear in mind that the first 3 days of that week were actually really good for Apple stock. But in the past week, the value of Apple stock fell by 13.5%.
That's pretty hefty in a few days. Yeah.
$30 a share.
How about since the start of the year, how has TSLA performed? Going back to 1/1/25.
Do I have to look up Tesla?
And it's one of the most widely held companies because people believe it's only going to go up.
Here's the thing. In the past week, Tesla was doing badly before because people were mad at Musk.
Yeah, right. It's a political thing. I get it.
A week ago, Tesla was at $249, and now it's at $239. But during the course of the week, it got as high as $283.
And then kaboom.
And then fell to $239. So for the week, it's down about 9%. Over the course, just for Friday, though, it was down 10, just that one day.
Now, this isn't going to sound much fun, but it's something that I know we were doing the last couple of days with our clients. And by the way, I want to thank our clients. Many of them are listening right now. Thank you, because I talked to all the advisors yesterday afternoon about how many of you were calling and saying, this is horrible. Almost none. This is part of educating our client. You should know that markets do this. As you said, Don, for whatever reason it is, this just happens. It happens. So I'm really thankful for our folks.
Do you notice? We are here live on Saturday taking calls. People have had 2 days to digest this downturn, a month to digest a couple of them, and we don't have a single panicked call right now. Not one. We don't have a single call right now.
The phone's still working. At
855-935-TALK. 855-935-8255.
Pardon me. Yes. Okay. But that's important. All right. Here's the other thing here's another lesson that comes, I think, out of all this. Cause it's one thing to get the news, the 5 trillion, and I won't mention the D thing, how many it's lousy, right? It's crummy. But here's the part that really disturbs me. It's when the so-called experts tell you what's coming next. This from Bloomberg. They call him legendary investor Bill Gross had a warning for prospective dip buyers yesterday. Don't. The co-founder and former chief investment officer of PIMCO said the stock market sell-off is a, quote, deep market event with little resolution in sight. Quote, investors should not try to catch a falling knife, he said in an email. This is an epic economic and market event similar to 1971, which apparently is earlier than the ones you were talking about, Don, and the end of the gold standard, except with the immediate negative consequences. By the way, good news, market veteran Ed Yardeni says, you should be buying the dip. It's going to go back up from here.
Oh, come on, Bill Gross. Why are we still listening to him? He was one of the luckiest money managers in history.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
Don't get why we keep listening to these experts. Oh, I mean, it actually infuriates me because Bill Gross got the moniker the Bond King primarily because Bill Gross just happened to manage a bond type fund, an income fund in the right period. He was in the right place at the right time with the right people behind him, and he borrowed a lot of money and he bet big on interest rates falling.
Yeah, and he was right.
As they did, he was right, and he bet big, so he made big money for his investors, but it's not because he knew anything. Interest rates just happened to fall when he predicted they would. And then when they started raising rates, he called the Fed on the carpet.
He got mad.
He got mad. Furious with the Fed because they were messing with his formula, and he lost his investors a lot of money.
Yeah. And then he went over to another firm, and that didn't work out either. Yeah.
You know, with the ARC fund, she was brilliant right up until she was stupid.
Yeah. So, no, that's a good point. I just think, again, if you have a plan, if you have all the things I just mentioned in the proper order, you don't got to listen to those guys unless it's entertainment. Then that's fine. Otherwise, no.
And that is where our good friend, and we really like Jason Zweig. We think the world of him. He wrote an article the end of this week about the market.
Yep.
And he gives some brilliant advice. He says, first thing, stop obsessing about the damage to your portfolio. And then he came up with this idea that he got from a guy, a money manager in California. It's to look at your life, your portfolio, not your portfolio, but the way you react to it as a pyramid. So you start at the bottom, and the bottom are those things you can do that you are very unlikely to ever regret doing. The second layer is actions you might later regret a little, and the third is big stuff that if you're wrong, you can't reverse it. So you don't want to mess with those. And he says, deal with the things at the bottom of the pyramid. That's where most of your life
reducing
lives at the
your
bottom.
Spending, stuff like that you can impact.
Reducing your spending. Maybe if things keep going down, you do a little tax loss harvesting.
Even rebalancing.
You rebalance, and you're buying some of the losers and selling some of the winners if there are winners. Improve your portfolio, like Tom said. Improve your diversification. But don't deal with the top part of the drastic changes. Well, I'm going to sell everything because the world is coming to an end. How many times in the past that you've thought that? And if you're an older person, I guarantee you've thought it at some past time. Don't lie to me. Are you happy you didn't sell everything and go to cash in 2008? Because you would have done it toward the end of 2008, right?
2013 or 2020 or 2022. These things come along. So, yes, but again, if you're properly positioned, both in terms of stock to bond, if you're properly diversified, if you don't hold those individual equities that can really get crunched, you're going to come out of this okay.
Now, that's not to say I am not trying to belittle the fact, because I know you guys think it gets all political here, and I hate it. I get in trouble from liberals when I don't go far enough to the right. I get in trouble with the right wing if I don't go far enough. If I don't go,
there is no middle ground.
There's no middle ground. I'm so middle ground. But the fact is, I do believe that tariffs are not good for our economy, and there will very likely be some damage from them. But is it likely to be permanent damage like so many Pollyannish folks out there want to make you believe it will be? It probably won't. It hasn't been in the past. The bank run didn't collapse all the banks in America. You know, the insurance company runs, the collateralized securities didn't destroy the
Union
economy.
Pacific going out of business. How about that, huh? Yeah,
whatever the heck that was. When was that? I don't even remember that one.
We're talking late 19th century here.
Oh, well, that was before even my time. That was before Bill Gross's time. 855-935-TALK. Call us. We'd love to talk with you.
Tom and Don are talking real money.
This episode is brought to you by Amazon Business. How can you free up your team from time-consuming office tasks? Amazon Business empowers leaders to not only streamline purchasing, but better support their teams so they can focus on strategy and growth. Free up your teams and focus on your future. Learn more about the technology, insights, and support available at amazonbusiness.com.
We're talking real money.
Ready to make your financial life better, improve your money situation, make your future brighter? We want to help you do those things, but we want to help you do them in a way that is sensible, logical, and involves, well, patience and planning, not overreacting. 855-935-TALK is our phone number every Saturday, 855-935-8255. And Patty, welcome to our program.
Thank you.
Thanks for calling.
I was wondering at what percent do you rebalance? I mean, with the market doing what it's doing, and I'm losing the stock portion of my portfolio, at what percent do I rebalance? Like, how far out of whack? If I'm looking at 60-40 or 50-50, how far out of whack do I wait before I sell bonds and buy stocks?
Whoa, that's so brave. You're going to sell the thing that went up and buy the thing that went down?
Yeah, good for her.
Well, that's what you advise.
Wow, thank you for listening.
Tom's
I'm just being, I'm like to hug you.
There, yeah,
little bit of sardonic humor, but this is really exactly what you should be doing, but so hard to do, right? Because it looks like the world's ending. Oh, you want to know the answer? Okay, the answer is, I would say 5%.
Really? Were you going to say 5?
Okay.
Yeah.
No, see, I think 5 is too low.
Well, that's what we do. That's what we do for our clients.
So are we rebalancing like 2 days in a row?
I don't know about that, but I do know there was some rebalancing on Friday.
Thursday and 5 on
remember,
Friday.
It wasn't 5 when you look at the globe, and remember, because we've got a global portfolio. So the first overlay would be stocks, bonds.
It wouldn't necessarily be 5 in my portfolio.
Correct. I don't know, so I'd have to see your portfolio.
I
want to make sure we're answering her question.
Yeah, because I'm talking about individuals, because it is kind of a pain. I mean, it can be a pain to rebalance.
You could get whipsawed too. Yeah.
Yeah, and that's why I do my rebalancing personally on my account. I generally, it's either every 6 months or every year.
Yeah, but you can do a time.
I set a timed thing because
okay.
Otherwise, I feel like I'm going to be rebalancing in a big down market or a big up market all the time. Now, I can understand if you're with an advisor who's doing it automatically, but if I'm doing it myself, I'm doing it on a clock,
on a calendar. But I would say 5% is reasonable because you shouldn't get whipsawed too much there. Here's the thing about rebalancing. As I said, it is counterintuitive. It can, as Don correctly points out, have to be done more than once. But you can look so darn smart because we did it in the spring of 2020. We did exactly what you just said. We sold bonds that had gone up 10%. And by the way, bonds are now up almost 5% this year, and bought stocks that had gone down. As you may remember, the spring of 2020, they went down about 30% in a very short period of time. So we made that rebalance, and then guess what happened? Stocks took off. So it was a brilliant move because we're so smart. No, it's just because we have a discipline. And that's you're doing the exact right thing, Patty. So congratulations to you.
Yeah.
Okay, so if I could clarify, if I'm going for 60-40 and my stocks get to 55%, either I just wait until the fall or whatever. We don't really have a time that we do it. Every time I've checked it, it's not been that far out of whack. So I've never rebalanced much.
Well, I'm a big fan of setting a date. You know, I've set mine for the summer, June and December. But you got to set the dates because otherwise it will become something you'll fudge on. You'll go, I'm going to wait a little while. I don't want to do this yet. So it's either a number, or it's a date. And I think to make it a less common process, if it's a number and a date, I disagree with Tom slightly. I would set that number at 10 because I think at 5 it just can happen way too often in a very volatile market.
Yeah, again, because we're doing it every day, it's easier for us than it would be for you.
Because the firm is doing it automatically, right?
Yeah.
Right. Yeah, for us, the hard part is the mutual funds in Vanguard that we have. We're transitioning to ETFs, but the mutual funds in Vanguard that we have, you got to sell one day and wait.
That's right.
You can buy ETFs the next. So
correct.
That's kind of a pain. But So
doing it less often for me would be better.
5 or 10% out of whack, I would then rebalance to my desired split.
That's right. I mean, and then if you're diversified among those assets, that's where it gets complicated, right? Because if you sell the bonds and buy the stocks, now you got to rebalance the stock part, right? And some parts have gone up faster than or down far. There's work to be done there. So it is a little bit time consuming. Yeah,
it can be a little bit time consuming. Thank you so very much for your call. We've got a line open for you now. If you want to call us, 855-935-TALK, 855-935-8255.
Tom and Don are talking real money. Your guides to a really great financial future. Tom and Don are talking real money.
It's time to talk money with you as we try to help you manage yours better than you did yesterday. 855-935-TALK is our number. And Karen, it's your turn. Welcome.
Hi. Can you hear me good?
We can. Thanks for calling.
Great. I want to thank you guys because you have been so helpful to me these last 9 years. I lost my husband 9 years ago and had to take on managing all this money on my own. So it was been really helpful with having shows like yours. Help me do it.
Glad to help. We're thrilled to help. Thank you.
So my question is, I am reaching that magical age of 59 and a half. And the last 9 years, I've been supplementing my measly public school education income from the proceeds of the life insurance that was invested in a brokerage account. And I think that, now that I'm 59 and a half, it makes sense to switch to supplementing my expensive lifestyle by taking money from the IRA, since you can't do the stretch anymore. But, I've listened to other shows, and they always say, brokerage first, then IRA, let it grow tax-free. But it seems like I'm just going to get walloped if I wait and do that.
Okay, now you've said several things here. Number one, this is money you inherited from a spouse?
Yeah, so my spouse died 9 years ago. So
okay, I thought I heard that correctly. All right, but you said...
I had the IRA, and then I have a brokerage account. And they're actually about evenly... it's about an even amount. I haven't looked the last 2 days.
But I want to make sure we get one thing factually correct. Okay.
Yeah.
Karen?
Yeah, I have about
first of all,
$1.5 million in each account.
1.5 million in each account. Okay.
Okay. But first of all, you can stretch an inherited spousal IRA. You do not have to take that out in 10 years. That could be stretched out. The IRS will rerun that on your life expectancy.
Right.
Yeah,
So you are not going to have to touch that. You're not going to have to touch that until 75, Karen. So it has another 15 years for it to 100% grow tax deferred.
So tell us a little bit why you want it. So did the reason you wanted to take the money out of the IRA was due to the fact that you thought you're going to have to take it out in the next 10 years, or was there another reason?
No, because I'm thinking that in terms of my estate, it'd be much better to leave my kids the life insurance money that's growing in a brokerage account, and they get the step up in basis, and spend down the IRA so that when I die, they don't have, a huge inherited IRA.
I have a really, really important question for you, and this is the most crucial of all. You're talking about a lot of disparate kinds of thoughts and pieces and parts to this. You're 59 and a half, you're a widow, you've got a lot of money. I mean, that's a fairly decent-sized amount of money that you may need more than your kids need. I think your kids should be a secondary or tertiary thought. Have you sat down and created a written plan, financial plan? Because if not, you should.
Not.
You should. You really, really, really. It will be money so well spent because it will put your mind at ease. Because it seems to me very likely, you said you would like to enhance your lifestyle, have more money to spend. To my mind,
I work in a public school.
Yeah, so you don't make a lot of money.
Not great.
Yeah.
So,
yeah.
No. And I don't know. I'm not saying you're greedy or anything. I totally agree with you. You've got this money and you deserve to live a comfortable lifestyle that makes you happy. I assume for a moment that your kids are all out on their own and doing okay.
No.
Okay. They don't. Do they need your help right now?
One does. They have some disabilities, and
then that
be financially independent.
Then that makes creating both a financial plan and an estate plan for you absolutely crucial at this juncture. I would not worry about where any money comes from for anything until I had both of those plans established, because you need to create some sort of a plan that is funded now, that you start funding now, to take care of that child who will not be able to live independently.
Right, which is why I'm thinking that the brokerage money is the better thing for...
No, but it may very well be, once you talk to a planner and an attorney, it may very well be that you're going to use money from that brokerage account not to pay your lifestyle, but to fund the trusts that will be necessary to take care of your child.
Yeah, I think Don's right. I think some serious planning. And by the way, back to your original point of contention around the taxation, it may make sense to pull a little bit from each one depending on where you are on your rate of tax, your tax rate, right? Your income tax rate. But again, that would be something the plan would put in place. You would also, as you say, work on something to take care of your child into the future. There's a few moving parts that I agree with Don. I think it really should be very thoughtful, sit down and work on that, then design the portfolios, et cetera.
Yeah, 9 years ago it was different, but now that you're getting closer to retirement, your child who needs help is getting older into adulthood. Now it becomes really essential that you not only have the estate plan, but the financial plan, which must include a tax plan and an income plan, which it will. Any good plan is going to include those things. And start with that before you even think about taking money out of anything, unless it's just a little bit to live on. And then I could see just taking a little bit out of the brokerage account for now until you have all these pieces in place. And that plan will tell you where the best places are from which to derive future income, because you'll know what that future income needs to be and what the best course of action is. Thanks so much for the call. We really, truly appreciate it, Karen. Thank you. 855-935-TALK is our phone number. Dan, you're up. Welcome to the program.
Good afternoon, you guys.
Hey, Dan.
Can you hear me?
Yes.
Yep.
So I have a question regarding market exit and entry. My question for you both today is, I currently have 18 individual stocks that I'm in the process of transferring from a management fee-based firm to managing them myself through a direct investing account. So my plan is to sell my stocks and purchase one or multiple ETFs, as you recommended last time I called into the show. Mm-hmm. Given the market currently, would you suggest I sell my individual stocks?
Yes.
Or purchase ETFs? Or
no. We think you should do exactly what you were going to do.
Yeah, I mean, here's the thing. You're going to buy the ETFs at lower prices. The stocks are at lower prices. There isn't I would just get on with it.
Yep. Do it. Never let the current market determine what your actions are going to be moving forward. Whatever your plan is, whatever you planned, and if it was a sensible plan, you just keep doing it. These events are temporary, could go either way.
Tom and Don are talking real money.
The spirit of innovation is deeply ingrained in America, and Google is helping Americans innovate in ways both big and small. The Department of Defense is working with Google to help secure America's digital defense systems, from establishing cloud-based zero-trust solutions to deploying the latest AI technology. This is a new era of American innovation. Find out more at g.co/American innovation.
For your real life and real future, Tom and Don are talking real money.
And before we wrap up this hour of Talking Real Money, let's go over here. Frank, welcome to Talking Real Money.
Hi, good afternoon, gentlemen. This is only my second time listening to you all. A friend turned me on to you guys. I got a quick question. My family has me working with a company called Edward Jones. We have about $300,000 with them. They do a lot of trading of stuff. And what I'm wondering is, would now be a good time to, just halt the trading, not sell or buy anything, and just hold at the current level, and nothing else that keeps me from getting the fees.
Frank?
Yeah.
Frank?
Well,
yeah.
Hold on.
Frank?
Okay. This has nothing to do with the current state of the market.
Nothing.
Okay? Nothing to do with it. Just put fire Edward Jones. Yeah. Fire Edward Jones, the whole firm.
And by the way, with $300,000, frankly, you could put that in a couple of exchange-traded funds and be just fine.
With Schwab.
You don't need anybody trading anything. You don't need anybody
getting
behind the curtain. Nope.
You're paying them a lot in commissions, and you could go to Schwab and pay zero in commissions.
Yeah, and again, my take would be, depending on the number of accounts you have this in, I would just have a couple of exchange-traded funds, maybe one stock, one bond, and get on with your life. Leave it at that.
That makes sense.
Okay.
Fire them.
Yeah, I don't know much about all this, but it's a lot of money, and this Edward Jones.
It is.
I'm just wondering about.
Do you know how much trading? Do you know how much trading there should be in an account in a normal circumstance? There should be in a normal account, you should have between 1 and 0 trades a year.
That's basically it. Yeah. The only trading that would be happening now is what we referred to earlier as rebalancing, and my guess is that's not what they're doing.
No.
It's just my guess.
Are you an American
selling something and buying something?
I'm sorry, you say?
Are you in the American funds with them?
I don't know. Every time I look, there's all these different lists.
Individual stocks?
List of stuff.
Yeah.
Yes.
Yeah. Okay.
Yep.
Terrible account. This is an awful way to manage money. They are just salespeople, overpaid salespeople who think they know the future, which they cannot possibly know. Absolutely. I would do something as simple as move it all over to Schwab and put part of your money in the Vanguard Total Stock Index and part of it in the Total Bond Index. You're going to be far better off. We could get a little more complex than that, but what you need to do, because of our time, is keep listening to the show and go listen to all of our podcasts. We've got about 1,600 of them online.
Keep you occupied for the weekend.
Keep you busy for a while. So, yeah, please leave them. Just leave. Sell it all, move out. Or move it in kind to Schwab and let Schwab sell it. You can just have them transfer the account over. They will do that for you. It's so easy. Just go to Schwab and say, or Vanguard and say, I want you to move my account over to you guys, and they'll do the whole thing for you. Boom, just like that. We got to run. We're almost out of hour. If you want more help with money matters, you can ask us questions online at talkingrealmoney.com, or you can meet with one of our advisors for free for nothing. Just click the button at talkingrealmoney.com that says Meet an Advisor.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appellate Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appellate Wealth, a fee-only registered investment advisor. Please see Appellate Wealth's ADV Part 2A on our website for information regarding Appellate's fees and services. Appellate Capital, LLC, DBA Appellate Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appellate does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.